Good morning. Top multifamily markets share a common playbook. And as the U.S. multifamily sector enters 2026, the strongest markets are no longer defined by rapid construction or speculative growth. And instead, capital is concentrating in metros that share a disciplined, repeatable formula through tightening vacancy, sharply curtailed new supply, and durable renter demand driven by structural affordability constraints. So, according to Marcus and Millichap's 2026 multifamily rankings, investors are rewarding the markets where fundamentals and not momentum are driving performance. And even as economic growth moderates nationally, these metros are producing defensible rent growth and reduced downside risk. So, the common thread here is there's an intersection between supply discipline and affordability pressure. And across top ranked markets, new construction has slowed dramatically following the post pandemic development surge. And at the same time, elevated mortgage rates and high home prices continue to lock households into renting longer. And this imbalance is reinforcing renewal strength, limiting vacancy expansion, and stabilizing cash flows, especially for Class B and workforce housing assets. So let's look at Florida's Gold Coast, a textbook case. Fort Lauderdale leads the 2026 rankings by pairing falling vacancy with minimal new deliveries of apartments, and rent growth is projected to exceed the national average, supported by in-migration and persistent affordability challenges. Whereas nearby, Miami-Dade and West Palm Beach reinforce the same thesis. Constrained supply and elevated ownership barriers are producing strong renter stickiness. And Class B properties in particular are benefiting from rising renewal rates as residents remain priced out of homeownership. So let's look at some supply constrained standouts beyond Florida. And in the Midwest, Chicago continues to outperform expectations. Despite softer job growth, vacancy is projected to remain well below historical averages due to limited new construction, which is allowing rent growth to persist where investors once expected stagnation. And on the West Coast, Orange County stands out with the region's tightest vacancy and some of the highest homeownership barriers in the country. And these dynamics anchor stable multifamily income, even as broader economic uncertainty lingers. So let's look at tech and AI hubs, which is a new demand catalyst. And technology driven metros are adding a new layer of upside. So San Jose is projected to post the strongest rent growth of any major U.S. metro in 2026 as deliveries collapse and as vacancy remains near historic lows. San Francisco is already seeing meaningful vacancy compression, particularly in their AI-linked submarkets. And Seattle combines slowing construction with a deep tech labor pool, which is improving long-term fundamentals. And these markets demonstrate how employment concentration and supply discipline can quickly restore pricing power. So some secondary growth markets still matter. So markets like Raleigh-Durham and Houston, Texas, showed that secondary metros remain competitive when job creation, in-migration, and restrained supply align. Now, Houston in particular benefits from steady employment growth and more measured overbuilding compared to prior cycles. And that supports long-term multifamily resilience across both core and suburban submarkets. So here's the investor takeaway. In the best multifamily markets in 26 aren't defined by explosive growth, they're defined by discipline. So think limited new supply, durable renter demand, and structural affordability constraints are creating predictable cash flow, defensible rent growth, and lower volatility. So for investors, lenders, and operators, these fundamentals matter far more than headline GDP growth in a cooling macro environment. That is it for the day. Please visit my website, Houston Real Estate Brokerage, to figure out how to get a hold of me. Love to talk to you more about your situation. Take care.